Welcome to today's live webcast release of the 2019 Global Travel Forecast. I'm Mike McCormick, and we're broadcasting live from GBTA's broadcast studio at our headquarters here in Alexandria, Virginia. We're really excited to have people tuning in from all over the globe today. The business travel industry is watching. Joining me in the studio today is John Gray, GBTA's economist and VP of Research and Insight at Rockport Analytics. John, welcome.
Good morning, Mike. Thanks for having me.
And joining us today from Paris is Christophe Renard, Vice President of the Solutions Group for Carlson Wagonlit Travel. Christophe, thank you for joining us from Paris this morning, or this afternoon for you.
Good morning, Mike. Good afternoon, everyone.
And also standing by will be Katie Raditz, Senior Director of CWC's Solutions Group. She'll be helping out later with the live Q&A in the broadcast, later on in the broadcast. So this marks the 5th year of our partnership with CWT to release this pricing forecast for the industry. We have a new interactive version for our audience this year that I think will be great. It's a great tool. We'll talk a little more about that later. And it's basically provides better understanding of the global marketplace, key price drivers, basically arming you, the listener, with upcoming budgeting and negotiating information for when you're out there talking and working with your supplier partners. So again, today we're really excited to have John and Christophe with us to talk about the forecast. So a little bit of a spoiler alert here. Travel prices are expected to rise again, actually sharply rising in some markets in 2019. And when it comes to the global economy, while most major markets seem to be trending in a positive direction, there are some downside risks that remain, given the rise of protectionist policies, Brexit uncertainty, and just world, global geographic, economic factors that are out there, environmental factors that are really going to have, as always, some interesting impact on prices and our industry. So let's get started. Christophe, let's dive in and learn more about the forecast. Why don't you give us a high-level overview of key findings from this year's forecast?
Thank you, Mike. Happy to do that, and very excited to share with you, the results of this forecast. I think we are the first one to release the forecast in the industry. So to start with, when looking at what the IMF is telling us, the prediction for next year are pretty favorable. The IMF is predicting GDP growth of plus 3.4%. And as we all know, business travel is very tightly correlated with GDP growth. We're also expecting that, the global trade is back to the pre-2008 levels. So all of those indicators tell us that the demand for business travel will increase next year. And as a consequence, we expect business travel prices to go up and to go up sharply. And that's going to be also backed by oil price increase. So looking a little bit at the details of what we are forecasting for next year, looking at the two largest categories for companies where they spend in business travel, we expect hotel prices to increase by 3.7% next year, and air prices increasing by 2.6%. If we look a little bit by region, we are seeing a kind of a moderate increase for the US, around 2% across air and hotel. APAC, for Asia Pacific, we are also expecting a greater increase, around 3%, 3 to 5% growth for air and hotel for the APAC region. For the Western Europe, we are seeing a much more robust growth around and above 5%, especially for Western Europe. While actually for Latin America, we are seeing reduction in the prices between -1 to -2%. As you said, Mike, there are some favorable and tailwinds that's going to push for those increase. In the US in particular, we believe that the corporate tax cuts will favor further corporate investments, and they're going to be good for the business confidence and for trade globally. And the IMF is saying that the US is expected to grow economically by 2.8%. Europe, actually, Europe is interesting. We have the prospect of a very strong growth despite the uncertainty around Brexit. we're going to have the strongest economic boom in Europe in recent years, with an economic growth of around 2% estimated. Now, looking at emerging markets, we are continuing to see kind of stable growth in China, and the overall region of Asia is expected to grow by 5.6% in GDP. And we believe that some important emerging markets like Brazil and Russia are going to recover from recession. So all of those tailwinds are supporting greater business demand and price increases in most markets. Now, as you said, there are some headwinds ahead of us that's going to generate a sort of uncertainty, the protectionist measures and the prospect of trade wars potentially. And Brexit, again, and we are very in the dark today about how that's going to shape, whether we're going to have an agreement or not, that's not sure. And also in many countries in Latin America, for instance, there are also elections coming in that are going to bring also uncertainty. So as you said, in a nutshell, we are seeing significant and sharp price increase, 3.7% increase in hotel category, 2.6% increase in air category.
Well, as always, right, many factors, and each year is different in terms of what the makeup is. And it sounds like some of these factors, and we'll come back to this, although they're happening now, may not necessarily have an immediate impact on travel. Some of these factors actually end up having 6, 12, even 18-month or more impact on the way travel is booked or as budgets are being done, correct?
Exactly. There's some dynamics like Brexit, for instance. We don't exactly know the agenda, the calendar. So, but we know that the full impact will come later into 2019. Even though there may be some kind of cautious attitude from some sectors in light of uncertainty of those events.
That's great. So let's go to John. So John, again, welcome and thanks for joining us here. So maybe take a minute and tell us a little bit about the report itself, how it's conducted, and some of your just initial thoughts, having been the one behind the scenes working on the report and helping to make all this possible.
Yeah, absolutely, Mike. Thanks for having me. The report is a very involved process. This is the 5th year now that GBTA has partnered with CWT on the travel price forecast. And every year it starts with a data model that we built a number of years ago and an update to that model. And so essentially what we're doing is we're looking at travel prices going back 9 years now across key segments, ground, air, and hotel around the world, millions of price transactions to help understand what sort of momentum and trends we're seeing in pricing. The other thing we're doing with that data is we're testing correlations with key macroeconomic variables that we know drive travel prices. Christophe mentioned GDP is a key metric that we look at, of course. We're also looking at things like corporate profits, employment. We're looking at what's happening with oil prices, particularly in the air sector. We're also looking at the supply side of travel. So what does the construction pipeline for hotels look like? How do we expect that to change around the world? How is air capacity being managed, and how might that impact pricing? And so testing all those correlations, we get a really good understanding of what sort of influence these various different variables have on pricing, and it allows us to extrapolate into the future. So with that data model, we do a thorough review of the forecast because the data model by itself is insufficient, right? We have our team of analysts and economists that are reviewing all of the forecasts in various different regions. We are aligning with GBTA's travel manager sentiment, what the forecast looks like and how that might differ from sentiment. We are using subject matter experts from CWT to really dig into these areas to understand what's going on. So a data model might not pick up something like new entrants coming into a market? Are there low cost carriers coming in that weren't in that market before, and how is that impacting pricing? Has there been some new regulation that's been introduced that is going to impact pricing in some way? Taxation. So there's lots of different issues that we're never going to fully cover in the data model that we do a full scale review on. So this is really a 5-month process that we go through to come out with the report and the results that we're releasing today.
So tell me, anything strike you in terms of some of the more interesting findings, data points that you saw as a researcher and economist? Anything comes to mind?
Well, Christophe hit on a lot of the high level trends. And so, one of the big things that we're watching from a macroeconomic standpoint is how long the current momentum that we have is going to last. It can be very difficult when we're looking essentially 6 months into the future now, if you go all the way to, or I'm sorry, 6 quarters into the future, if you go all the way to the end of 2019. So we're really watching what's happening with the global economy. Over the last couple of years, we've seen a pickup in momentum. We've seen more synchronous growth between major business travel or corporate travel markets around the world. And that momentum is playing itself out in 2018, where we expect to see the highest level of business travel demand since we've seen since 2011. So a big question for us is, how is this momentum going to carry over into 2019? What we're seeing so far is that early in 2019, we expect that momentum to stay. But as we get towards the latter end of the year, we're going to face a lot of headwinds. We're seeing interest rates on the rise. We are getting towards the end of business cycles in developed markets like the US, Europe. Europe is a little bit less mature in their business cycle now. And we're seeing inflation start to spike a little bit. We're also seeing travel costs, or costs for suppliers rather, start to rise. Insurance costs are on the rise. Energy costs are on the rise. Labor costs are starting to rise. And so we think if we can maintain these strong levels of demand, we're going to see these larger price increases as suppliers aim to pass on some of those costs to business travelers.
Well, and maybe we'll come back to this a little bit later, but there's also a lot of pressure on those same companies. If you look at the airline sector, hotel sector, they're having record profits, or have been, which the stock market rewards while they're at record levels, but always wants more. And it's all relative. And so as those, as oil prices go up and some of those negative factors take effect, it seems to have an impact certainly on those businesses. They're pushing to, squeeze more yield, raise prices, but there's limits to what you can do even in a healthy economy. So it is interesting. I think some of those factors, I think you're right on about, some of the things that definitely stood out as for me as well in the report. And just also, again, you're getting to a point where, is it an issue whether not so much that there's a big downturn coming, but is there basically a bit of a stagnation coming, in some of the key markets? The other thing I just want to ask you too, there seemed to be, to me, a lot of variability between some of the more, let's say, high growth markets and those that aren't. A lot of variability there in terms of the range of types of increases we'll see market by market, and we'll come back to that again a little bit later. But is that any more or less than usual, or is it pretty much, do we see that every year? Have we been seeing that every year the last 5 years of this report?
Yeah, we see it from year to year, especially when we have good times like we have now. And we have had emerging markets really struggle in years past. And what we're starting to see is emerging markets start to rebound. There are a number of credit risks and lots of other things that are happening in emerging markets that we're keeping an eye on. But emerging markets are doing much better, which leads to these higher rates of growth. The other thing that we're seeing is a lot of changes in currency dynamics. So all of the forecasts are priced in US dollars. So as the dollar appreciates, as it has over the last number of years, there can be these volatile swings, and we see it swing back the other way in a period like 2019, when we expect the dollar to start to lose steam against some of these other currencies, in particular the euro.
Well, certainly more we'll dig into as we go through this, but maybe this is a good time to kind of dive into the sector by sector information. Let's look at airline, hotel, and ground. So maybe just kick that off. Christoph, let's go back to you. And why don't you set the stage a bit and tell us what we can expect to see specifically in the airline industry? Because, as we know, the airline industry basically drives the travel economy for sure.
Right. Yeah. I think we're going to see a lot of very interesting developments in the airline industry in 2019. Some of them, being the continuum of what has already started in 2018. And I would like to start with, the interesting developments around, ultra long-haul flights. We're going to see like next October, they're going to be, Singapore Airlines is going to open the route Singapore to New York. That's going to be interesting, and that complements already 2 long-haul flights existing between Perth to London by Qantas and Sydney to Houston by United. So those kind of 18 to 19 hours flight, that's going to be interesting to see how that's getting popular and used. There have been some trials in the past which were not successful. Some airlines stopped the service. It's going to be interesting, and I think 2019 will be really the year when we see if that works or not. On the other side of the spectrum, you have also more and more low cost entering these long haul markets. That has already started, but we're going to see an acceleration in 2019 around this. Today, we already have 21 low-cost carriers in 17 countries operating long-haul, per se, low-cost routes. 10 of those countries sit in Asia. We all know that Asia is a particular, popular market for low-cost. It has always been, like US was a little bit out of the picture, but that's not going to be the case anymore with, World Airways planning to relaunch itself toward the end of the year. So there's going to be also interesting to see how those long-haul, low-cost carriers become popular and integrated into the corporate programs of companies. I would say, so that's going to be the NDC, the new distribution capabilities standard by IATA will also continue on those developments with airlines trying to, as you said, to improve their margin even more than they have today. Even if the situation is much more healthy than in the past, they will continue to do so. And the ability to merchandise their content and their rich content through all channels will be an even greater opportunity for them. So we'll see stronger push for that. And I see that's going to be interesting also to see that GDS will becoming more and more like level 3 NDC compatible. So we'll have more and more rich content being kind of distributed through GDSs on top of the direct airline websites. So there are also kind of other trends that are pushing for the air price increase that I mentioned. Obviously, the oil price, we already talked about it. John mentioned that. We're going to see 2 effects. Obviously, that's going to put upward pressure on the price, depending also on how the airlines determine their hedging strategies. Some of them will be able to not kind of pass on the oil price increase to the end customer, but some of them will have will be obliged to do so. On the other side, that's going to be also interesting to see that all companies operating in the energy sector will kind of increase also their spending as their business is doing better. So as it's those are big business travel spenders. So we're going to see those typical routes from Houston, from Sydney, from Perth. That's going to be much more kind of crowded. John alluded to that also. I think one interesting development is going to be the shortage of pilots. That's interesting to talk about this. But as the routes and the overall traffic is increasing, and as airlines are purchasing more and more aircrafts, they need to have more and more pilots. And today there is a shortage of pilots. So the cost of recruiting, the cost of training is going to become more and more important. It's interesting that actually the labor cost became the largest operating cost for airlines since 2016. Obviously, it's when oil started to decrease, so that labor became the number one cost item. But now that even oil is going back up, we still see that cost labor is actually the largest cost for airlines. So that's going to be interesting. That's going to have an impact on the end price of the tickets. And obviously, I think one of the key drivers is going to be all those ancillary services that airlines will continue to try to push to kind of improve their yield. That already started. We have seen the introduction of basic economy fares. We anticipate a stronger push from airlines to favor that, and we have seen there was an article yesterday in the press about American Airlines kind of easing the conditions to kind of for corporates to soften a little bit the conditions of reusing those tickets if they happen to see that the constraints are not kind of relevant for a corporate traveler. So I think we're going to see more and more of this, which is making critical that for all companies to really track all their spend, not only what is booked through the TMC, but also what is really spent by the travelers. So all in all, when you look at the numbers, again, we anticipate 2.6% increase in air prices. When we look at the breakdown by region, APAC is at plus 3.2%. With China at plus 3.9%. There's a significant increase here in China on air ticket price. We are seeing some markets like New Zealand, India, where we anticipate a plus 7% increase on the air tickets. So that's really significant, and especially India. India is expected to be the third largest business travel market by 2025, and already today airports are operating beyond capacity, so that is putting some pressure upward on the price. Japan, on the other side, we expect a reduction on the price for Japan as they anticipate and prepare for the Olympic Games in 2020. They're expanding, they are starting to increase their capacity, and that's going to create more supply. Western Europe, I mentioned that, plus 4.8% expected on the air prices for Western Europe. Again, that's helped, as John said, as the euro is expected to operate favorably against the dollar by against 4.8. That means in local currency, more or less a stable prices. But in some markets like Germany, France, or Spain, that's still anticipated, like around the 7% increase on the air price. Meaning in local currency, that's around 2 to 3 to 4% increase. So that's a significant increase. For North America, and especially the US, we anticipate a plus 1.8% increase in airfares. So still a moderate increase. There's still very high competition from the low cost and a push for basic economics that will make kind of the average air price kind of enjoy a moderate growth. This is what kind of I could cover a broad landscape on the air side, Mike.
Well, there's a lot there. I mean, in everything you just said, I mean, I think each one of these could be a program into itself, right? We have the ultra long haul routes coming in, like you said, NDC, pilot shortage, ancillary fees on the rise, and then of course just the variability by region. When you see, depending on how the fast growth markets, the ones that are still, growing like in India on one extreme, and then having, like a special situation, like you said, like a Japan, where you have all this capacity coming on, which is the opposite, and then everything in between. Really interesting, as we always talk about the fact that, business travel drives business growth. It's a leading indicator in general for the economy at large. And once again, it really does play out that way. When you look at the numbers, you look at like a market like India, which has been just fast growing, still fast growing, nothing but, and to your point, certainly from an airline perspective, airlines are at, airports are at capacity already. What the only thing they can give is, basically prices raising, because, suppliers are clearly going to take the opportunity to get more yield out of the marketplace, because they can't necessarily increase capacity anymore, at least in the short term. So you have those issues. One thing we already got questions coming in from our audience, but one area that came up already is interesting. They want to know a little more about the impact of NDC. It's so, for everyone that is not as close to the issue, NDC is in some ways very simple, but in other ways very complex. I mean, the simple part, in a sense, is that it is a basically a standard that which airlines are using, and we're basically trying to push through the entire distribution system to allow them technically to do things more in terms of merchandising, segmentation, in terms of the audience they reach. I mean, ultimately, for airlines, they would love the ability to basically customize an offer or a deal or a fare for virtually every traveler. I mean, so that every situation is different. In that environment, they can increase their yields even further. But clearly for the distribution system, it takes time for everyone to get comfortable, everyone from the buyer and then all the intermediaries and everyone through, not just to do technology, not just the technical part to do the work, but the commercial part. Any thoughts from your perspective about NDC, the role it's played, and is that part of what's driving some of these price increases?
Yes, definitely, because as you say, it's about, the intention is very good. I think everybody embraces, the good intention of NDC about, having a more personalized offering, and for the airlines to kind of, be able to push their rich content through all channels. So obviously, and that's a way to kind of increase prices so that they're able to kind of push additional services to the travelers, targeting the right segment, and obviously, they would push different offerings to the corporate segment and the leisure. So, there's a high virtue about, being able to offer more personalized proposals and options for the corporate travelers. Now, the challenges are still there in terms of for the end user, for the corporations, and I guess many on the calls here kind of wonder what it means for them in terms of additional distribution costs, because obviously what they want is to kind of making sure that through the kind of traditional distribution channels, which are typically, the GDS and the TMC, they have access to that rich content without having to bear additional distribution costs. So we still believe that on the TMC, and I'm really talking here about, being the advocate about the TMC, talking for CWT, we believe that shouldn't add complexity, no additional costs for the end user. And so our really aim goal is to make sure that we bring in some credibility and security for the end user to make sure that they can access the same content, whatever the channel, because that's really a key challenge. Corporate travel buyers, travel managers don't want to feel that, if I go direct to the website, to the airline website, I'm going to have access to a different content that if I call my TMC or if I go to my online booking tool. So that's the key dynamic, just to make sure that we do not add complexity nor additional costs.
Right, and it still comes back to basics in that respect. The corporation's paying the bill. They want to know what they're buying and how much they're spending, and have that transparency that no matter what channel they're booking through. The other thing I wanted to call out was on ancillary fees. What you talked about that, and certainly we've seen since the recovery of the economy over the last 7-8 years, and the recovery of the industry to reach our point today, ancillary fees have played an increasingly larger role, and certainly probably a dominant role in terms of the profitability of all of the airlines. Interesting though, when you mentioned or touched on the basic fares, where in order to compete with low-cost carriers, the established carriers are doing more and more where they're trying to drive and push those basic stripped-down fares. One interesting stat that we found from our surveying our buyer members, that almost 70% of them, it's like 65+%, actually don't allow those fares to be sold to their travelers. So it's not like it's had some impact, but it's not one where that's really caught on with and definitely been accepted by the managed travel environment. So before we leave airline, I guess any other thoughts or comments? I mean, we'll come back to it later in the questions. But again, I think, again, a lot of interesting factors, and some that really are new in this year relative to other years. I mean, we see that maybe every year, but this is a very different set of factors driving the price outcome.
Yeah.
So, okay, John, let's go to you, and let's talk a bit about the hotel side. Nothing happening in this sector. Just kidding. Actually, probably an incredible amount. I think in the last year or so, we've seen more activity, or 2 years, we've seen the most activity in the hotel sector than we maybe have ever for a very long time. Certainly, consolidations, mergers, and acquisitions are playing a part of that. But let's talk a little bit. Tell me, what are we seeing in the hotel sector, and give us a little sense of what we see coming in terms of prices.
Yeah, sure. So as you alluded to, Mike, the hotel sector is doing very well. We expect that to continue as we move into 2019, and the strongest price growth that we see globally will be coming from the hotel sector with a 3.7% year-over-year gain. As is always the case with hotel, it's very localized, so it differs from region to region in terms of what's happening, and from country to country, and even from city market to city market. So it's obviously important for travel buyers to really get a sense of what's happening in the markets that they do business. So globally, 3.7% growth is what we're expecting next year. If we look across regions, Asia Pacific and Western Europe will witness some of the highest growth in rate in 2019. Asia Pacific, probably not a surprise to most. Some of the usual suspects are going to continue to grow rate. China, India, just like Christophe mentioned, very strong growth in corporate demand overall, which is really driving rate, and supply is just not growing fast enough to keep up. Also, other established or developed markets in Asia Pacific, like New Zealand and Australia, doing very well. We expect high rate growth there as well. In Western Europe, in local currency terms, it's mostly moderate increases across the board. But again, when we look at what's happening with our expectations for the exchange rate as we move into 2019, for those travel buyers that are buying, for example, in the U.S. into the European market, they can expect to pay a premium of about 5% next year over what somebody buying in euros will pay. So prices in dollars are going to go up much more sharply in the European market than they will in local currency terms. We're obviously keeping a close eye on Brexit. It's very early to try and anticipate exactly how things are going to shake out until we really know what the trade agreements look like between between the European Union and the UK. That's really going to have a huge impact, not necessarily on continental Europe, but on the hotel and air markets in the UK. So trade, obviously a big deal for business travel between markets. We touched on it, or I think, Mike, you mentioned it in the introduction. We have this sort of overhang of trade wars and tariffs and policy, and we have a administration that is, let's say, a bit unpredictable or unconventional in getting some of these trade deals done. So we're still watching very carefully to what happens and how these trade deals shake out. You know, when we look at the correlation between global business travel, this is outbound business travel, and the growth in global trade, we see that global trade explains about 56% of what's happening with global business travel. So anything that reduces the level of that global trade is going to have an enormous impact on the industry. Other regional markets here in the U.S., we expect moderate growth. We're still going to have a little bit of a tailwind from corporate tax cuts that have come this year. That will help to support strong demand in the first couple of quarters of 2019. But of course, we still have the overhang and the risk of trade policy and what might happen in that arena. And then lastly, Latin America. Again, in local currency, we expect some pretty big spikes in major markets in Latin America, like Brazil and Argentina, that are experiencing relatively high rates of inflation. But we also expect their currencies to depreciate against the dollar. So when we switch back to dollar terms again, we actually expect U.S. buyers to get a discount buying into those Latin American markets. While if you're buying in local currency, you're going to see some pretty big rate hikes in the hotel sector.
So I think, some interesting things as you went through all of that, the things that to me that are unique to the hotel market and are driving, I think will drive some future, outcomes. We'll be curious to see, clearly air, hotel, car, ground, all generally follow, a similar pattern, right? One drives the other, et cetera, and certainly all play a key part in driving the economy. But, the hotel sector specifically, there's been more and more consolidation. No reason to believe there won't be more to come, that we'll see more deals being put together, more consolidation as, the brands feel the need and the competitive need to get big, and the big keep getting bigger. No end in sight in terms of new properties being developed and growth of capacity in the market. But again, doesn't seem like with the amount of demand that's out there, more hotels coming online, but ADRs, average daily rates just continue to increase. So there doesn't seem to be, all those factors seem to be in play. The other thing I always find curious is that the number of actual brands, even though companies consolidate, the brands themselves largely aren't being retired. They're still supporting, a large number of brands in their portfolios, leveraging obviously scale, distribution, et cetera. But none of that seems to slow down or change. There's new brands being developed and launched virtually every week. So a lot of interesting factors specific to hotel. But like you said, it sounds like the immediate future is certainly one that continue to be healthy for the hotel sector as well.
Yeah, and you make a good point, Mike. One thing that we see in the hotel sector in particular is when there are these spikes in demand, like right now when we have, like I said, the largest level of corporate travel demand this year we're expecting since 2011. There isn't time necessarily for hoteliers to react to that immediately. There's more of a lag. There's more planning time that goes into hotel construction. And so it takes a couple of years for these markets to sort of catch up with demand. So when we do have good times, we see larger spikes. And, in terms of consolidation, we're not thus far anticipating huge impacts globally, from the 800-pound gorilla that was the Marriott-Starwood merger. Just because there has been a fair amount of growth in supply, not just traditional hotels, but also what's happening in the peer-to-peer space with more Airbnb type properties coming online.
Right.
But when we drill down deeper, the consolidation will have a big impact in certain markets. If you look at, for example, the footprint of Marriott and Starwood, there's not going to be a big impact on rate necessarily in China. But here in the U.S. in particular, in specific markets, we definitely expect there to be a little bit more pricing power and rates to increase.
Yeah, and then that's the different, and certainly the hotel market, very different, right? You can have huge variability. It's not necessarily a country issue. It's much more of a city by city issue in terms of the number of properties, the capacity, and actually the economic environment just in that market, single market alone. So very, interesting little nuance or difference between that and other sectors. Well, let's go to our final sector that we want to talk about specifically, and it's ground transportation. Again, Christoph, back to you, but boy, talk about a sector that's dramatically changed with the advent of ride sharing and the impact that's had globally. Let's talk a bit about what's been happening specifically in ground transportation.
Yeah, and you're right. Behind ground transportation, you have the rental car traditional sector, and you have also this ride sharing and the high-speed train and just rail. What we're observing on the rental car sector is that companies are going to face increasing fleet costs. The new cars are more and more expensive, and the maintenance cost is increasing, and the residuals on used cars is really reducing. So the rental car companies would be under huge pressure, and they will try to find ways to improve their margin. So we expect actually, overall, we expect a flat price evolution next year, but actually we anticipate that, especially in the US, towards the last quarter of 2019, there will be kind of a concerted efforts to really increase prices, and we believe that's going to they will try to increase prices around 6%, just to protect their margin facing those challenges. What you're observing, so on the ride share, obviously that's gaining momentum. It's very popular today. That's interesting to see how those ride-hailing companies are teaming up with actually rental car companies. When you're observing what Hertz is doing with Lyft in the US, when Hertz is kind of renting their cars also to Lyft drivers. So you can see kind of a interesting dynamics within the industry between those two actors. From the old economy, from the new economy, actually that has becoming very popular. Like, you know, the revenue from 2016 has been over $500 million through that partnership between Hertz and Lyft. We're going to see more and more regulation around, you know, the ride-hailing companies. We all know the dynamics in London, where London stopped Uber in London, but then it's back now, but under kind of a 15 months probation notice. We have seen some interesting dynamics also at some airports, because that became to a point where it was congestion. Like, you know, there was too many of those ride-hailing cars. So more and more airports or cities are regulating that, depending on regulation or because the traditional taxi drivers are doing protests. So those are interesting dynamics. I think also technology, as in all sectors, will also make a big change. Connected cars will become prevalent. Avis has announced, you know, all their fleet is going to become connected by 2020. So we're going to see that really coming in very sharply in 2019.
Very good. Okay, so let's. I think we're going to take just a little break here from our conversation and go to a couple questions from our audience. We've got some interesting ones coming in. So one specifically. Someone asked about wanting some data specifically on Middle East trends. I know it came up on a couple of the charts, but anything, could we maybe touch on those? Anything specific in each of your areas? Is Middle East, I saw on the ground transportation, relatively flat. Are we looking at basically flat figures in Middle East relative to other regions?
Well, Mike, I'll comment on, you know, hotel. I think, I don't have the numbers in front of me, but I think we're expecting fairly large increases, moderate to large increases in most of the Middle Eastern, in particular, the oil producing countries, as you know, oil prices continue to rise in 2019. We expect a pretty healthy level of demand. So I'm not sure, Christophe, if you have any of the numbers, the actual growth rates there or not.
Yeah, it's exactly what you said, John. What I would like to add is interesting dynamics also is what you're observing with Turkey, and in particular Turkish Airlines, you know, really growing its airport and its terminal. It's going to be the largest terminal in the world when they, you know, terminate the works in 2019. So you're going to see really Turkish Airlines in particular trying to compete with this hub from, you know, for all the flights between Europe and Asia, and that's going to create some pressure, some downward pressure on the price from the Middle East carriers. So that's going to be interesting to see.
Yeah, I know you mentioned Istanbul and the airport, you know, comes online at the end of October this year. And again, talk about, you know, those types of, you know, you look at that airport, that capacity and the amount of ramp up they have, and that's just one situation. In one way, it creates, you know, a lot more service, could put pressure on other long haul carriers, because clearly they want to be the not just the point to point, but certainly the connection point of choice for travelers going anywhere around the world. So they have high aspirations in terms of that, you know, that offering. That could, you know, basically could also put some pressure on prices competitively, correct? You know, over time, when you bring on all that service, and then it pushes other carriers, and a service level pushes other carriers that maybe have to compete more on price. Interesting dynamics. Okay, let's go to another question. It's possible, someone asked, is possible put figures against the hotel rate increases. When we talk about huge increases, moderate growth, or slow growth, just generally, what do we talk about in terms of a range of increases? Obviously, is like basically 0 to 2% considered slow to moderate growth, or how do we gauge slow, moderate, or larger or aggressive growth increases? John, maybe this is a good one for you.
Yeah, Mike. So speaking in general terms, if we think about inflation more broadly, anything north of 2.5–3% is generally a pretty strong growth in inflation, and so we sort of look at it the same way. These travel commodities tend to be, as we talked about before, a little bit more volatile. So we can expect some larger rate increases than what we'd see in CPI, for example. But I'd say anything over a rate of growth of 2.5% or so is
considered
moderate to high. And then but it really depends on what market we're talking about. If we saw a 5% growth here in the U.S., it would be staggering, and it does happen in the hotel sector from time to time, but generally we're south of that, and 4% is a extremely strong rate.
Right.
But if we're talking about some more volatile markets in the Middle East or Latin America, it's not a surprise for us to see pushing double-digit rate increases from time to time.
Yeah, but even when you hear like of India with 7%, projected increase in pricing, that is truly aggressive, right? I mean, that in terms of the landscape of the market, and I think because again, this is price increase, not volume or volume increases. This is just literally from year to year. That's significant. So okay, so give you So any 2 to 3 is probably in a more mature market situation. It's still considered to be strong, moderate to strong in terms of a price increase. Anything beyond that, definitely, and more likely that you're going to see something in a more, let's say, more mature, stable situation. You're probably in that 1 to 2% range from year to year, correct?
Yep.
If I'm getting it right. Okay.
Yep. 1 to 2 is pretty standard. Anywhere in that 2–2.5% range is typically what we see in a normal year for a mature market.
Okay, so let's switch gears. Stepping back from all of this data, a lot of interesting factors, insights, drivers behind the price increases that we're projecting. But now let's talk a little differently and come back and say, okay, look, behind all this, as we know, we've got new technology, innovation that's really, always changing the face of the global travel programs. Everything from artificial intelligence, the data analytics that are available today, new products here coming online. There's been a huge push on personalization of travel. And I would say again, in a sustained, healthy economy, the focus turns, more to value, more to time, and the value being put on travelers' times and their ability to personalize their travel experience. And certainly, we seem like we're right in the midst of that now. Christoph, why don't you take that one? Tell me a little bit from your perspective about how you view and how CWT views this issue.
Yeah, Mike. So I think there's all actors within the industry are really, trying to enhance the travel experience and to digitalize it and to make it more seamless and easy to use. There's a greater, there's more and more concern around, travelers' productivity because it's, lost time for people. Sometimes, the salary is important. So there's a greater concern to make, the experience a little bit more easier. And I think the hotel is really speeding up in terms of the adoption of technology. We're seeing beacon, facial recognition, automated checking in. We know that the airline industry, have already introduced a lot of new technology for some years. we're really seeing a strong acceleration in the hotel space. That's going to be interesting. So yes, I think there's all of this is really moving to more seamless experience, digital, all on the mobile, right? And also personalized. So it's really about backed by data and advanced analytics. It's about understanding traveler behaviors, traveler habits, preferences, and in terms of the corporate environment, it's about finding the right balance between, the framework of the travel policy of the company and also each individual traveler's preferences, habits, etc. So that's what data can really do today to push for more personalized options and experience and advice, addressing contacting travelers differently if they are frequent travelers or if they are very infrequent occasional travelers. So we're really seeing that kind of data is an enabler to produce and deliver more personalized and digital experience.
Yeah, the other thing too, I mean, we've seen in kind of related studies when we survey companies and survey travelers and talk about what drives their even employment decision, basically how they view their employer, travel and travel policy and the ability for an employee to have more control over their travel experience is actually becoming a big factor in terms of how people are choosing companies to work for and how companies are viewing making themselves more attractive as an employer. Very different times than even where we were as little as 3 or 4 years ago in that respect, correct?
Exactly. No, exactly. And we are also observing, even travelers also, as you said, the comfort of the travel is important, but also the frequency of travelers. Even consulting companies, they would tell you that nowadays, they can't attract anybody, even young people, if they say, oh, you're going to leave on the Monday morning and come back on the Friday night, and you're going to travel or every time, even if it's a comfortable travel policy, nobody anymore accepts that kind of frequency of you. So the work-life balance is also important.
Yeah. And John, I'll take this over to you, but all of this is heavily dependent on access to data, people sharing data, and actually a lot of the regulation in and around how companies can access, use, transmit data. And of course, we're talking about GDPR in Europe and how that's become, really a factor everywhere in the world, because in a global economy, everybody's doing business in Europe or any other part of the world in some way. So no one's immune from changes in regulation. Talk to me a little bit about the impact that's had or any we expect to see.
Yeah, I mean, you're exactly right, Mike. And GDPR it's sort of the other side of the coin of personalization, right? Because as Christophe talked about, it's so important for companies to be able to provide personalization and to be able to use this data effectively. And we're finding with GDPR that there's a lot of companies that are sort of behind the curve with using the data in a way that consumers and the regulation itself dictates it must be done. So there are some short-term costs, no doubt, to a lot of companies. Our industry is very reliant on data. If we think about the travel ecosystem, we've got traveler data that's going between TMCs through booking tools, various different suppliers, and the consumer has to trust that it's all being taken care of. So it will create some short-term challenges for companies and some costs to make sure they're compliant with GDPR. But I think in the long run, it's going to make things healthier. It's going to make trends like personalization better, because you have consumers, you have travelers that trust that their data is being used properly. They know they have ownership over it, and in turn, they're more willing to share it. Right?
Yep. So certainly the having those regulations go in place at a time when generally the economies are all healthy and robust is certainly a good thing. I mean, I think that seemingly in the short term, the marketplace can absorb those costs and those impacts maybe a little differently than at other times. Okay. So something to keep an eye on, though, for sure. because it could have a limiting impact on some of the ways that necessarily travelers and or companies would want to offer their products and services. Well, both of you, I mean, again, can't say enough about the terrific information data that you've shared with us today. I think it's been you kind of brought the report to life. A lot of, like you said, I think you could do probably a Facebook Live session like this on any one of these sectors with all the information that we've shared here. For everyone on the in our audience and out there, I would say the best thing you can do is download the full interactive report. It's a really, really well done report that not only gives you all of the data, but really kind of brings it to life in a sense of bringing a lot of good insight, some of which you've heard today, but even more so, it gives you a great resource to use as you're working with your supplier partners or anything else you need to do in and around the travel industry. And even for analysts out there looking for some insight on what's to come next year, this is a good place to start. So thanks again to John for joining us in the studio here today. Christoph, thank you for joining us live from Paris and providing a terrific overview of the report. So live from GBTA Studios, I'm Mike McCormick.